Hello, welcome to chapter 2. We're going to be looking at trade and risk management. Now, when we talk about trade management, this is very important because without trade management, you wouldn't have a good grasp of where to enter, where to exit, what to target and all of that. And it's very important that we understand this because it's when you understand this, then you can effectively build upon all that we're going to be learning on how to manage your trade effectively. Now, Forex money management is a set of self-imposed rules successful traders follow in order to manage your money effectively. So when you talk about trade management, money management in Forex trading, it's similar. Okay, I want to talk about Forex trading, of course, Forex, crypto, financial assets trading, essentially, it's similar. So these are just rules that you have to put in place for you to effectively minimize your losses, maximize your profit, and essentially grow your account size. Now, effective risk and money management. Now, the fact remains that learning how to become a profitable Forex trader, or profitable trading in general, is based on your capacity to develop a proven, tested, and profitable trading strategy over time, your own methodology. Okay, so capital preservation in Forex and trading should be an essential component of your trading strategy or plan. Very important. And you may have the best trading strategy if you don't have a good grasp on your emotions, you don't have a good grasp of what it takes to follow your own trading plan, to manage your money and to manage your risk effectively, then you're still going to have challenges really becoming profitable. Okay, now here are some tips for successful risk and money management. Now, number one, only trade what you can afford to lose per trade, per time. Okay, so if you're trading a personal account, for example, only trade what you can afford to lose. A lot of the times when I interact with traders who are still struggling to become profitable, you discover that most of the time they only think in terms of profit, not in terms of loss. And the first thing you must always remember is that what is sure is that you will lose that money. That is what is sure. So if you know that is what is sure, then what do? You now work on what you need. You now work on yourself so that you only risk what you can afford to lose. Right? So Forex trading, of course, is not a guaranteed money maker. And if you have the understanding, it will help you in the long term. Now, 2, quantify your risk per trade. You have to know your risk per trade. Okay, so what are you risking per trade? Don't just enter because somebody said, oh, if you're trading this amount of lot size, you're not ready to succeed, and because of that you just put in a lot size that you haven't taken into cognizance the risk, in terms of the dollar value for your risking. Okay, so if you know they're going to risk $10 per trade, or 100, or 1,000, 2,000, 5,000, depending on your level, you have to understand what that means for your account. Okay, that's very, very important. So you have to quantify your risk per trade. There is, of course, a tool which I'm going to be introducing to you. You will see that of course, in the program, how to set up, the risk management, the EA, the expert advisor that would help you sort of automatically calculate your risk when you want to enter trade, so you don't have to do that manually. Okay, so 3, you have to establish your risk to reward ratio. How much do you want to take per trade? 1 to 3, 1 to 4, and you have to be consistent. If you're not consistent, your result will also not be consistent. It's as simple as that. So if you're going to stick to 1 to 3, stick to 1 to 3. If you're going to stick to 1 to 5, stick to 1 to 5. Okay. So this is very important because consistency is the bedrock for longevity. I hope that makes sense for you. Okay. Now, you of course can choose whatever you want to do, but make sure you're just consistent. Now, the next tip I want to share with you is that you must also respect leverage. Now, depending on the type of account you trade, some brokers will give you 1 to unlimited, 1 to 1,000, 1 to 100. So you have to understand leverage and don't abuse it. Now, if you have a good grasp on how much you're risking per trade, leverage wouldn't really be a problem. Okay, you may not have to really bother yourself so much about this. What I tell people to focus on is forget about all the jargons. Just focus on how much are you risking per trade. Are you risking $10 per trade, $100 per trade, 500, 1,000, 2,000, 5,000, 10,000? That is what you need to understand. If you understand that and you understand the dollar value of what you're risking per trade, you wouldn't have problem with your trade management. Okay. Now, withdraw profit. Okay, this is very important. When you trade, you withdraw your profit. It's good to pay yourself at the end of the day. Okay, you work, you withdraw profit, you repeat the process again, and you withdraw profit. It helps to show that whatever you're doing is profitable. Okay, so you need to stick with that. This is a very important aspect, of trade money management. When it comes to trading in general, forex, crypto, stocks, whatever it is, you have to learn how to withdraw. Okay, now let's look at this lesson 2 on position sizing, new slippage, and all of this. Like I mentioned, when it comes to position sizing, I'm going to be sharing with you a different video that shows you, there should be a different video that shows you the position sizer tool that you can install in your MT5, and it will help you, with managing your trades. Okay, so you know how much you're risking before you enter, how much your potential profit is going to be, and all of that. So that should be there. Now, as part of risk management, proper sizing, position sizing is key to managing risk and to avoid blowing out your account or losing your funded account on a single trade. I believe you've seen people who just tell you that, hey, they lost so amount of money on one single trade. That's not really wise, right? So you have to understand how much you're risking per trade. This is very important. Limit the risk depending on your account, okay, to 0.5% if you're trading a prop firm account. Okay, just limit your risk. If you're trading personal account, that percentage value may change, but if you're trading prop firm account, to stay within the objectives, so you don't lose the account, you don't breach rules, stay within 0.5 to 1% per trade, or per day rather, 0.5 per trade, for example. So you have the opportunity to take at least 2 trades, London session, New York session, and all. Now, you also need to start focusing on one pair. If you're just starting out, focus on one pair. Don't try to get everything. This is very important, okay? Just focus on one pair for a start. Later on, you can decide to diversify, trade as many pairs as you can, as I do. But for start, just focus on one pair and just make sure you nip that in the bud. That would help you in the long term. Now, the position sizing is very important because if you know how much you're risking per trade, it will help you calculate how long it will take for you to lose an account. So here, for example, I have an example of a $200,000 account. So if you're risking 0.5 per trade, this is what it's going to take you. It's going to take you about 10 trades for you to lose about almost 10%, of the account. It will take up to 10 trades. On the other hand, if you're risking 2% per trade, it will take you just about 10 trades, or as a matter of fact, it will take you just about, let's say, about 3 trades to lose almost the same amount, of the same amount, of your account. And that's incredible. You just have to think about that. Okay. So as a matter of principle, if you're trading prop firms, don't risk more than 0.5 per trade. Okay. And don't risk more than 1% per day. This is me, okay? This is me advising you on what is best and how best you can really manage your money long term. So you have to think long term, okay? So the lower your risk, the longer you can stay in the market, okay? If you're very disciplined and you stay within your plan, the longer you can stay in the market. But the more you increase your risk, the faster you can also lose your account, or the faster you can sort of get kicked out of the market. So that's very important. Now, for the position size, still on position sizing. So here I have, for example, if you lose 10% of your account, what does it take for you to get back to break even? If you lose 20%, so the more you lose, the more percentage of your capital that you lose, the much more work will be required for you to actually get back to break even from where you started. Okay, so this is very important to understand. Now, protecting your account is super important for you to last long in the market. And I have a few tools here that they have on the screen. And you should hopefully see that also maybe in the description section. So you have the position size calculator that helps you calculate your position size. But really, this is not something I would advise you to be using. I would rather you install the position sizer EA, and that's the link there. Install it on your MT5, and then you can easily use that, to calculate your position size when you're taking a trade. If you're trading off your phone on your MT5 software, you can actually, when you move around, the the tools, for entering a trade, you can see how much of your account you're risking per trade. So that should be something also I believe that you should be able to do without issues. So just to make sure that I'm actually not just saying this without showing you how this works, let me try doing something here. Let me try showing you something very practical. Okay. So just a second, let me get this up and running, and then I can show you how this actually does work. Okay. So I think I would need to kind of share my phone with you. Just a second. Let me share this with you. So on the same page. Okay, cool. So I believe you can see this. Now, you can see here on my screen that I have here, this is my phone. I'm showing this on my screen. And you can see here that I have this tool. Basically, that is showing here that, please just a second. Okay, so you can see here, as I move my stop loss, this is your MT5. So this is typically your MT5. Okay, so you can see that as you move your stop loss up and down, the dollar value changes. Okay, and then you see here your lot size and also your potential profit. So on MT5 on your phone, you can actually know how much you're risking per trade. If you want to change your lot size, you tap on this button there, and then you change this. Let's say we change this to 1, for example. Okay, this changes and shows us that, okay, we're risking about $209, for this particular trade, and we have about 20 pips stop loss, 65 pips takes profit, and this is just about 1 to 3 thereabout. So you can use that to kind of get a hang of how much you're risking per trade. Now, this is in addition, of course, to the position sizer EA tool, that also another video there. I believe you can see the video for setting that up. So you can use that to help you with setting up your your risk management or your trade management tool in your on your platform. Okay, so that's that for that. Now let's talk about news and slippage. Now, whether you like it or not, every now and then, you would have news that would cause maybe the market to kind of create a gap, or sometimes the market will just slip beyond your take profit or beyond your stop loss. Now, this would happen a lot of time over the weekend, and thankfully I'm recording this on a weekend where the market just opened with some gaps, and I'm going to show you that. Now look at this. The market just opened a few minutes ago, and you can see here the market closed here on Friday, but clearly you can see as the market opened, it opened with a gap here. You can see that, and that happened also the previous week. Let me show you that. So you can see the market opened last week too with a gap, and then eventually pushed up, sold off, and then started closing the gap. So this is an opportunity for to trade into this. Hopefully closes the gap before it continues trading downwards. But this would happen in the market, and you have to be ready for this. So if, for example, you had left your trade over the weekend and you did not probably the market, the gap opened in the direction of your stop loss, you would have probably taken much more loss compared to what you would have planned to have taken. So that is something you need to have an understanding about. And also, when there is high impact news being released, sometimes it can lead also to slippage, and that's something you have to plan for. Okay, so you can see here, slippage almost always happens when the market opens each weekend on Sunday night. It's a result of the weekend price gaps. If you stay in a trade over the weekend, be very wary. Okay, Sunday nights are unpredictable. In general, this is not a good day to trade, and the reason for this is simply because over the weekend a lot of things can happen. Maybe the US is placing tariffs on China is saying they're going to place tariffs, and all of this trade wars happening here and there, and as a result of that, the market is going to react to that when it opens. All right, now managing your risk. I've already said that you need to learn how to manage your risk. Okay, if you're leaving your trade over the weekend, you have to make sure you understand the implications of what you're doing. Okay, you either close your trade, new week, new opportunity, you get new opportunity, the market's not running anywhere, you trade again. So you have to understand that. Also understand your risk when news releases are on stream. It's very important that you understand how to make sure that you don't get slipped when the news is coming out. Okay, CPI, FOMC, NFP, all of these are high impact news. Federal funds rate, all of these are high impact news that can significantly cause slippage in your trading. So essentially, slippage is as a result of some volatility. They can cause volatility, low volatility, high volatility. All of both can actually cause slippage depending on where you are in the market. Okay. Now, that said, let's look at trade execution order types. Now, this is very important because if you understand all of these order types, it helps you to know how you're going to enter the market. Most of the entries, in fact, all the entries I'm going to be teaching you in the stock in profit trading strategy, section chapter 3 is going to be based on limit orders. Okay, and what is a limit order? So here, for example, you can see here we have a buy limit, we have a sell limit. A limit order simply says you're going to place your trade at a position and wait for price to return to your position where you've placed your trade before you get triggered in. So limit order is a pending order. So you have market orders, you have limit orders, pending orders. Pending orders are orders that are entered waiting for price to come to you first before you enter. Market orders are executed just where price is. So market order simply means price is here, I'm selling from there. Pending order simply says I have to wait for price to come to where I want to enter, and until price comes there, I'm not entering the trade. That's the simple definition of a pending order and a market order. So limit orders simply just do that. You wait for price to come to you before you get triggered in. A sell order, you wait for price to come to your point of entry before you sell. Now, we also have the buy stop and the sell stop. Now, for the buy stop, you're simply saying you're placing your trade ahead of where price is so that when price gets there, price can trigger you in. That's what the stop orders simply refer to. So for the stop orders, you're not waiting for a pullback. You're simply placing your entry ahead of where price is. When price gets there, it triggers you and then it moves. So that is how that works. Okay, so I'm going to show you also an example just in the chart so you understand the difference. So like I said, we have two major entries: the market orders and the pending orders. The market orders, you're buying where price is, just sell where price. Pending orders, you're waiting for a pullback and then you enter. So here's an example. Now we see here the market open with a gap. So I'm going to say something like, okay, the market is short, I know. So I'm going to say, okay, I'm just going to put my entry here, put my stop loss above this area, and I'm going to wait for price to come, tag me in before the short continues. So this is a stop, this is a limit order, but based on the fact that I'm waiting for price to close this gap, tag me in, and then the sell should continue. Okay, so that's a limit order. Now a market order is I'm saying price is already here. I'm just going to put my entry here exactly where price is, and I'm going to sell directly from there. Okay, so that is a market order. So I'm selling where price is exactly. Now, what is a stop order? It simply means saying, okay, price is here right now. I'm not going to enter this trade. I'm going to wait for price to come here. When price gets here, then price should tag me in, and then the rise should continue. That's a stop order. Okay, so I hope that makes sense. Yeah. All right, so that is that for that. So still on trade execution, I've already explained what limit orders are and also what buy stops are, but this graphics is just to buttress the point more. So here you can see current price is here. This is where you place your order. Price comes, tags you in, and then moves. The same thing also for sell. Price is here, you put your entry here, price comes, tags you in, and then sells. Your stop loss is price is here, you put your stop order ahead of where price is, price gets there, tags you in, and continues. Your sell stop also the same thing. Price is here, you place your order ahead of where price is, price gets there, tags you in, and then sells off. Simple stuff. But this is also going to be buttressed more when we get into maybe taking trades and all. So I want to believe you're able to put a few pieces together. Now let's look at the last section of this, and this is lesson 4, trade management. Set and forget, take partials, and swing break even. I'm going to explain what this means. Now, when we talk about the set and forget, trade management principle, it simply says when you enter a trade, you don't take no profit until that trade hits your take profit. Simple. Okay, you don't move your stop loss to break even, you don't do nothing, you just wait for trade to hit your TP or your stop loss. Now, I usually use this for when I'm targeting 1 to 3. There's nothing to move. I just wait for price to do whatever it needs to do. However, this is very important. If you're targeting beyond 1 to 3, my advice usually is that you need to use a different type of trade management, and that leads us to the second one, which is take partials, or even swing break even. Now, what that means is that for take partials, you can decide to say, okay, I'm targeting 1 to 5. So when it gets to 1 to 3 or 1 to 4, I'm going to take a certain percentage out of the market, okay, and then leave the remaining to hit my TP. That's as simple as that. Take partials, okay. And then the swing break even is simple. You're saying, okay, I want to swing this trade. Now, this trade maybe is a 1 to 10 or 1 to whatever number above 3, above 5. Now, instead of me, just leaving my risk in the market, I'm going to take my risk out when it gets to 1 to 3. So what that means is that I'm going to move my stop loss to break even once it's hit 1 to 3 and allow the market to do the remaining until it hits my final target. Okay, so that's the swing break even trade. So the 3 types of management here: set and forget, 1 to 3 trades, take partials, maybe 1 to 4, 1 to 5 trades. Once it gets to 1 to 4, you take some partials and allow the remaining to hit. You can do that also for swings. And then the last is the swing break even. So if I'm swinging the trade, I'm just going to take partials. No, I'm not going to take partials. I'm going to move my stop loss to break even once it hits 1 to 3, and then I'll allow the remaining to go hit my target. So these are the 3 simple trade management styles I use in the market. I'm also going to see that eventually. Okay, so this is it. I want to believe you've picked something from this. So just to reiterate, the trade management we just looked at. Now, let me give you an example. So look at this trade here now. To this level here is 1 to 6. So if we're trading the set and forget, we usually only target 1 to 3. And once it hits 1 to 3, okay, we take our profit and we're done. Now, if we're targeting, let's say 1 to 5 now, and we're using the second trade management, model, which is, what do we call that? Take partials. That simply means what we're going to do is that once price gets to 1 to 3 or 1 to 4, we'll take some percentage out and then we'll allow the remaining to come hit our target. And then if we're really swinging it, maybe 1 to 8, 1 to 10 and all, we can just simply say when it gets to 1 to 3, when price got here, we'll just move our stop loss to break even. So eventually, if price reverses, nothing is going to happen. We're not going to bite our fingers and say, oh, we should have done this, we should have done that. No problem. It's just going to be a break-even trade and we're good to go. But if price continues to drop, then we're all in the good. All right. So I hope this makes sense for you, and you're beginning to put all the pieces together. So that is it. So now with this, we're now ready to look at the stock in profit trading strategies, about 4 models that we're going to be going through. Okay, so let me take a pause here and see you in the next lesson. Bye-bye and cheese. Just before we go, by the way, we've looked at a few things. So if you have any questions, just put in the comment section, and just engage with other students too. See you in the next lesson. Bye-bye.